The Economic Times magazine for the period of 17th February to 23rd February had a beautiful article written by Mr. Samir Bharadwaj. Okay, focusing on how the RBI is managing the liquidity of money in the country, right? So in this video, we are going to delve into that particular article, and we are going to be doing a complete postmortem of that particular article, wherein we will be seeing what he is talking and what are the measures that he is using, and of course, how is the liquidity position of the country right now, right? Or to be more specific, of the economy of India right now. Hello, everybody. This is Samvit Narayan, and welcome to Samvit Money Minutes. First of all, let us look at what is banking liquidity. Banking liquidity is nothing but the money that is easily available for the bank to lend, right? Okay. Now, this indicates how easily can bank monetize their assets. So, for example, bank is having some assets like land, like basically how even the non-current asset and the current asset both can be monetized by bank. How quickly they can convert those assets which is sell those assets and convert them into money. How easily they can do that? That is what is measured by the banking liquidity. Right. So adequate liquidity ensures the stability of the financial system, ensuring more money supply so that inflation does not happen, or in extreme cases, deflation does not happen. The economy stays straight and stable all through the year or all through the period. Right. So that is the measure of banking liquidity. Now, moving on, the recent liquidity scenario. The net liquidity, okay, the net liquidity in the banking system turned into a deficit in the December 24 and January 25. So the net liquidity is nothing but the difference between the amount borrowed by the bank and the amount that is deposited by the bank with the RBI, right? Now, the liquidity deficit hit a multi-year high of 3.2 lakh crore just on 23rd Jan 2025. I am stressing the term just on Jan 2023. On that one day alone, the deficit has gone down to 3.2 lakh crores. Right? We'll see the graph. So, in order not to get confused with January, I'm stressing the term again. On 23rd January 2025 alone, the deficit was 3.2 lakh crores. Right? RBI's measure helped to reduce the shortfall, and we'll see what the measures are. Now, in terms of the graph, okay, net liquidity position was having a surplus of 1.34 lakh crores on July, and extreme cases lab on November, it was having a surplus of 0.53 lakhs, right? But on December 2024, the net liquidity position went down to 1.32 lakhs, and January it was 1.75 lakh crore, and in February, due to the rate cut, it came up to 0.84 lakhs. Ignore March for now because it's just a prediction, and the prediction has come to 2.75 lakh crores. Right, the deficit is expected to go to again 2.75 lakh crores, making March having the highest deficit. Right now. Recent rate cut and liquidity. As we know, the repo rate was cut down by 25 basis points to 6.25%. Okay, the benefits could be delayed if the liquidity remains in deficit mode, right? And the rate cuts among the tight liquidity will be slightly negative for banks as it will create something called margin pressure. Let me explain you what margin pressure is. Say for example, the bank is lending at a rate of. I'm talking before. Let's take two scenarios. So in the scenario number one, the banking is lending at a rate of 14%, and the bank is giving the depositors an interest of 7%. So the difference between 14% and 7% is 7%. This was their profit, right? Now, this particular liquidity scenario has forced the bank to reduce the lending rate from 14% to 10%. That means the profit of the bank will be 7%, 10% minus 7%, which is 3%. Now the profit has reduced by 4% because from 7%, it has now reduced to 3%. So the profit has reduced to 4%. Now, because the profit has to be deliberately reduced by the bank because of the liquidity. And this pressure, which caused the bank to reduce the profit deliberately, is margin pressure. I hope we can proceed, everybody. And I hope you have understood this, right? Now, moving on to the next thing, which is the next thing that we're going to see, which is the measures that the RBI has taken to boost the liquidity in the economy, right? Now, first is the measures in the cash reserve ratio. The cash reserve ratio is nothing but the ratio, is nothing but the percentage of the money, of the deposits that the RBI must deposit with the bank, right? I mean, the bank must deposit with the RBI. Sorry for the mess up of the words. The portion of the deposit that the bank must deposit with the RBI. Now, if at all this cash reserve ratio is cut, that's what has been happening. It is cut by 50 basis points to 4%. If it was cut, then the bank will need to keep a lesser amount of deposit with the RBI, and it will have more amount of money for using for lending, and of course this indeed will increase the money supply in the economy, right? So since it was before this amendment, it was 4.5%. Now it is cut to 4%. That means, say for example, bank is receiving 100 rupees, and 4.5 rupees it needed to keep it with the RBI, and now it has been reduced to 4%, so that 96% of the money it can be used for lending to the public, right? Okay. Now the next thing is open market operations. That is, okay, open market operations is nothing but the buying and selling of government securities in the open market. If the RBI is buying more securities, then it is giving more money to the bank, because in exchange of money, the RBI is buying the securities, and in exchange of the securities, bank is giving the money to the RBI, right? So it's just selling the securities. Now, if at all the securities are bought by the RBI, which is happening right now, the RBI will give more money to the banks, which indeed will boost the money supply, as I told in CRR. Now, a special type of securities called G securities, which is nothing but like I'll read the definition and I'll explain it, which is nothing but debt papers issued by the government of India in place of the borrowing. Just like how we have debentures in company, the same way this is one government version of debentures. or RBI is version of debentures which it is given to the public banks, right? Or banks basically. Now the RBI is purchasing 60,000 crore in G securities through open market operations in three installments over January and February. Right now, this will boost the money supply in the economy because it is buying the securities and it is giving more money to the bank. Okay. Now moving on to the third thing, which is 56-day variable repo rate. Now, the variable repo rate is a tool for managing liquidity. It is a short-term lending rate that is based on the market conditions. The RBI usually conducts short-term VRR to manage liquidity. Now, it announced the long-term VRR of 50,000 rupees or 56 days on February 7th. Now, starting from February 7th, the variable repo rate repo rate is going to be conducted for 56 days on 50,000 crore, right? Okay, so in order to boost the liquidity, of course. Now, okay. So the USD INR swap is nothing but I am there and one of my friends is there. Okay. Now, say for example, I'm going to enter into a deal with my friend, wherein I'm going to say, hey, I'm going to I'm going to take my dollars from you. Okay. So I'm going to give you some of my Indian rupee, right? And what I'm going to do is, I'm not going to sell this now. I'm going to sell this at a later date. That is, I'm not going to sell this dollar now, immediately. I'm going to sell this at a later date. But of course, you can keep my Indian rupee, right? That is what the RBI is actually doing. Wherein RBI is buying dollars from the central banks, okay, wherein it is giving Indian rupees in exchange of that. But the RBI is not going to sell those dollars now, but at a later date. I hope you have understood it, right? Now, through this particular operation, the RBI can actually boost the rupee liquidity in the economy, and of course, it will increase the money supply, right? Now, the $5 billion have been swapped by this particular operation, wherein 43,000 crores are injected by February 4th. And additional steps include 60,000 crore open market purchases, and of course a 56-day VRR auction addressing a 3 lakh crore liquidity deficit, right? Now, moving on to the next point. We are going to talk about something called LAF corridor, right? Now, the LAF corridor is the difference between the repo rate and the reverse repo rate used by the RBI to manage liquidity in the financial system. Now, in the current LAF corridor or liquidity adjustment facility corridor, excuse me, MSF rate is the corridor ceiling, whereas SDF rate is the corridor's floor. I'll show you the graph, of course. The repo rate stays between the MSF rate and the SDF rate, right? Now, and the RBI manages liquidity to keep WACR close to the repo rate. I'll explain what these are in a minute. Okay, this corridor, which is, so this is the graph of the LAF corridor, wherein, just give me a moment, let me zoom it. Yeah, wherein repo rate is this red color line which you are seeing here is the repo rate. Now, MSF rate, as I told you, is at the ceiling, and floor is the SDF rate. Okay, I'll explain what it is. The MSF rate is the rate at which banks can borrow funds for overnight from the RBI in case of emergency. And FTF rate is the rate at which the banks can deposit excess funds with the RBI without offering collateral. So the borrowings from the RBI in case of emergency has been increased, and the deposit to the RBI in case of emergency has been decreased. So in between the borrowings and the deposits, the repo rate is okay, which is the rate at which the bank can borrow in case of short-term liquidity needs. So borrowing in case of emergency, okay, depositing in case of emergency. இது ரெண்டுத்துக்கும் நடுவில் which is at the center of these two short-term credit facility offered by the bank, offered by the RBI, right? So now this particular region, as which I am sharing here, is only called as the LAF corridor, right? So that particular region there is what is called the LAF corridor. So one more thing, I was talking about WACR, right, which remain close to the repo rate. The call money market is where the banks can lend and borrow overnight funds, right? So the RBI manages liquidity to ensure that WACR remains close to the repo rate, ensuring stability in the short market interest rate, and of course, effective monetary policy transmission. Okay, so now the rate at which banks can borrow from the RBI in case of short-term needs, and the rate at which one bank can lend to another bank in case of emergency, both of these rates are going to be almost same or close to each other, right? If they do so, they are ensuring stability in short-term interest rates and effective monetary policy transmission. Consolidating the entire discussion, we have seen what is liquidity, and we have seen the different tools which the RBI uses for liquidity. And of course, we have seen many concepts like CRR, WACR, repo rate, and everything. And we have also seen mainly what is LAF corridor and why is the WACR close to the repo rate. So I hope you enjoyed this video, and I hope it was very fun for me to research about this topic. This is one of my the personal favorite topics. If you like this video, please do hit the like button and subscribe to Sambit Moneyman. Meet you again soon in yet another video in Sambit Moneyman. Until then, this is Sambit signing off from here. Bye.